thinking about. And incidentally, if you haven't checked out our oral history on Bloomberg.com of that day, it is a fascinating read. Of course, we're amidst earnings season as well, so it's about the fundamentals as well. And this is a slower growth earnings season, or at least it's expected to be. Take a look at the Bloomberg. We've got the earnings per share estimates for the S&P 500 and the year-over-year growth it's estimated. So we've come out of this earnings recession now. We've got 4 quarters under our belts of growth, and there is estimated to be growth this quarter, this past quarter that we're reporting now, but it is slower growth, as you can see, before an expected increase in growth by analysts. One of the things that's going to pressure earnings this quarter, the hurricanes and their effect on companies like insurers, for example. But we'll see how the numbers come in and how the forecasts look from the various companies as well. One of the companies in focus this morning is Apple, and not just Apple, but as always, the Apple ripple effect as well. There was a report in the Economic Daily News that Apple cut its November and December orders of the iPhone 8 and the Plus by about 50% on week sales. This isn't the first report of this kind, of course. There's been concern about orders for those phones. There's also a lot of speculation about whether consumers are just waiting for the iPhone 10, and that's why. Whatever the reason, Apple is down 2.5%. Obviously, that's a big pressure on the market. And then many of its suppliers, Cirrus Logic, Qorvo, Dialog Semiconductor in Germany, are all trading lower. One of the other companies that's putting pressure on its sector is Genuine Parts, the auto parts retailer. That company coming out with earnings that missed the lowest analyst estimate for the third quarter. They cut their full-year earnings per share forecast as well. The company CEO says he is intensely focused on the plans and initiatives underway to cut costs and improve profitability, but you see the whole sector is trading lower. And finally, as we see money flowing out of stocks here in the U.S., where's it going? Well, we're seeing it go into bonds today. The 10-year yield down by 5 basis points, so that in turn putting some pressure on financials. We've got the dollar selling off versus the Japanese yen, and gold is catching a bid as well. Mark, a bit of duck and cover this morning.
Julie, check out what's happening here. All 19 industry groups are lower today. The stock 600 down for a third day in full. Biggest drop, by the way, since August the 29th. Lowest since September the 28th. It's been led by weaker than forecast earnings, which I will come to in just a minute. Utilities, best performers, personal, household goods, the worst performers. Not just the big decline on Wall Street 30 years ago on Black Monday. Big decline here in Europe as well. These are percentage declines since 1987. Back then, 30 years ago, Europe's benchmark fell by 8.5%, which was the most on record. Here in London, the FTSE that day fell 10.8%. The next day, it fell by 12.2%. That was the record. The DAX plummeted 9.4%. That puts history in perspective. Yesterday, we saw the V stocks, Europe's volatility index, fall to a record low. This year, it slumped by 39%. The region's volatility, a volatility gauge, has surged by 32%. It's now near a record high relative to the V stocks. This is this chart signaling that investors are paying up to hedge themselves against turbulence in the marketplace. Let's finish off with what's happening in Spain today. This is the spread, the difference in yield between the Spanish and the German 10-year. Earlier, we went out to 1.28%. We're at 1.23%, roughly a basis point higher. The country said it will move forward with the process of suspending the powers of the Catalan government following the president's refusal to drop his claim to independence. Investors will be watching closely the next moves by Madrid and the regional government in Barcelona amidst a potential ECB announcement on tapering next week. On October the 4th, by the way, the spread moved to 1.33%. That was the highest since April. It then came down to 1.17%. We're at 1.23% today. What a day, Bonnie.
Well, Mark, as you just mentioned, 30 years ago, investors learning just how quickly markets can shift with that 23% drop. Now, we're not anticipating another Black Monday anytime soon, but then when do you ever, right? And are dangers lurking below the market's surface? Mark Connors, Credit Suisse's global head of risk advisory, has been examining why investors have been unmoved by global chaos and joins us now in London. Mark, it's fascinating. We are seeing a grind lower today, and we'll see how the day ends, but certainly up to now, investors have been pretty complacent. Is this a market that considers itself invincible?
Yeah, from a positioning standpoint, I mean, obviously, asset managers, hedge funds have to be in the markets every day. They're mandated to do so. So the way that they've been managing through this elevated valuations, tight spreads, and still trying to garner returns for their investors is they've concentrated a lot in the equity markets in technology. I think we just looked at some returns on the day. Obviously, every industry group down in the last couple of days. But broadly on the year, infotech and internet retail have returned on the order of 18 to 23%. So they're concentrating. They are cautious. When we look at the interest rate book we think we have hiking, we think inflation's there, but hedge funds are still long bonds. So that's a defensive measure.
So are you saying basically that technology is the new Dow transports, for example? Is this going to be a signal for the next drop or even plunge?
It is. Watching the positioning and price action in technology is absolutely going to be the new canary in the coal mine. It used to be emerging markets, high yield. I think infotech and some of the subsegments and software will be what investors are watching.
Mark, what do you liken now to? I mean, back in '99 when the Nasdaq doubled, just before it crashed, we had that last-minute surge. We haven't had this in this bull market. People are likening it to '95, 2013, when the S&P, rose by 30% with little peaks of turbulence. What do you liken today to when we're looking back at Black Monday in 1987?
I would say it's more like two periods, 05, 06, probably, where we had tight spreads. The difference is the LIBOR regime was up at 5%, and here we are at, plumbing 50 basis points to 1.25. So not as much ammunition in the weaponry of the central banks to protect us today. So yes, like 05, 06, but different. Also like August of 15. So that's the scenario that we're speaking to clients about to run their books on. How are they positioned for that?
Given that you could miss a quarter of the gains in the back leg of a bull market, what do you recommend investors do? There's that fear of missing out, isn't it? FOMO. Never said that on air before. Let's get it in there.
First time?
Yeah.
So, I think when we go back to, 08 was the most recent, teachable moment. And you had some CEOs say in front of Congress, while the music's dancing, you got to keep moving. So that's the point you're making about the last quarter. People are invested, but they're not as leveraged as they were. So that's the cautiousness. If we have a rollback, and this was something that you folks wrote about recently, people will reengage down 2, 5, 10%. There is this idea that things will march higher. It's just a matter of time. And to take the hit because it's going higher.
Mark, what about the winds of fiscal policy change? We spoke with Sir Richard Taylor last week, the just newly minted Nobel Prize winner, and he had this to say basically about U.S. tax reform and why that's maybe an argument or not an argument for how markets are moving, at least in the U.S. Have a listen.
I don't know about you, but I'm nervous. And it seems like when investors are nervous, they're prone to being spooked. And nothing seems to spook the market. As you said, it just crawls up slowly but surely. And if it's all based on the expectation of some big tax cut, surely investors should have lost confidence that was going to happen, given what's happened so far out of Congress.
Do you get calls, Mark, about the U.S. tax reform, and do you have a position on whether we might see a drop if it doesn't happen?
It's the number one topic today. I mean, it was Fed balance sheet forever, but when you look at what happened during the U.S. election, a lot of volatility around there, but you saw what happened to banks. It was thinking that we were going to have fiscal policy for the first time in 8 years take hold, and when that happens, you have discretionary decisions. It's not just one monolithic lift in assets. You have actually money put back in the hands of companies, individuals to make decisions, very constructive. That is what drove markets. It went away in the first part of this year. It's being resurrected. If that does fade, there will be concern.
Although I want to tell our viewers, do read the Bloomberg Business Week article, which Mark is in, prominent part of it. Absolute crazy stock market punishes anyone who dares sell. And within that, Mark, it says, usually in the context of sort of post-crisis upheavals, you've got lots of incoming calls. But everything changed with Brexit. Why?
If you look at the probability of Brexit, no one was positioned for it, and so that's where we look at polls are fine. No one was positioned for Brexit. It wasn't in the mindset. It wasn't contemplated. So the fact that 3-4 days later the markets took off, we think in the investor's mindset that whether it's central bank policy or other drivers, if Brexit didn't take the market down, what will? So yes, we mentioned August 15 earlier during that vol spike. We got a lot of calls because a lot of perturbance in the market, and it lasted for a while. We saw that in January 16, certainly. We saw it earlier in taper tantrums, or October 14 during that rate spike. We haven't seen it since. So people are sort of focused on their books, how to manage it, but not a lot of concern. Now, we are meeting with people because what they're doing, we think, instead of reacting, they are tooling up and getting more calibrated with quantitative strategies, even if they're fundamental folks. So they're doing a lot of work, but as we saw in the article highlighted, you've been paid to take the hit and keep going.
Mark, you got to come back soon. We got to check in with you pretty regularly, I feel like, these days. The VIX almost hitting 12 today. That's Mark Connors, Global Head of Risk Advisory at Credit Suisse. Let's check in now